MMT's S&P 500 got above that neckline slightly to 1204.49, up 25.68 handles. As we were shorting the S&P right here at that failure, the deep downside volatility to that bottom, we came up and we consolidated. We had a 2 to 3 buy day, and we were putting in that Thursday bottom. There's that Friday narrow range trade, and then here's that Monday trade. We got CPI, PPI coming out. We've got a slew of data coming out in the morning. The market's looking for good news. That's all good and well. Down here, we got sold out. We were calling the bottoms on Thursday, how bottom, bear trend bottom, upside volatility works, and when to cover out the shorts and get net long. And we've been getting net long off the bottoms every day, and that the seller and the margin debts and lots of other things that happened were they're out of the marketplace right now. And basically what has happened is we have put these bottoms in here. We've got resistance 1 right here. That's this upper trend line, which was the bottom of that low. That was back on 8.3. That's resistance 1. Resistance 2 into the 20-day declining moving average, declined over the 20, the 50, and the 100 are all pointing down. The moral to the story is trading bear market, or not bear market reversals, but bear trend reversals. And we covered our shorts down here because once we peaked and came up off of here and we had that sell down day, we couldn't break the low. That's when it was on. The minute that it passed half of that bar, that bottom was on, and we haven't looked back, and we've called it right once again. The thing that you want to know with all the key indexes and the way that trade management will work within their indexes is that as they go up and hit those resistance levels, it's going to take a long time for these broken down declining moving averages to turn around. The upside price action volatility is nothing like the downside volatility. Knowing when to sell, buy the bottoms, but knowing when and how many days. So we're at day 3. We got day 4 and 5. Monthly options expirations in the play. Selling into resistances at different areas. Intraday highs on stocks will pull back. They're not going to sell off real hard, though, but they're going to give great trades on those entries. And on this here, this was the first neckline. This is where we got above this trend line right here. These bars down here, and this is all standard stuff, as you know, MMTs, how the mathematical high-frequency computing machines turn directional movement changes, not so much humans buying in the tape, but those high-frequency volume computing machines are running at high octane because they wouldn't go any lower, so they levered up the trend this way. And that means in order for this to happen, you have to be bought. There are lots of electronic trades with those machines that get placed intraday on high volume within milliseconds and high volume frequency now, that they buy the leadership in the S&P, and that's how you get the indexes to move. 10-day moving average will have to flatten out over time. Any move up to these different levels intraday will be trade management to sell short before they go up, and we'll see how things set up during the options volatility monthly. They expire Friday. It's when we really get outside of this expiration that is going to be the key, because the dog days and the light volume days are good to trade up to resistance, but you have to know when to be coming out. And the put to call ratio was totally out of whack, meaning that the calls were very deflated and the puts were very high. We peaked in the volatility index at the high, and the VXO, and the VXN, and the VIX. And we hit those highs and those reversals, which also confirmed the bottoms in the indexes. Trade management, as we get to each level intraday, we will be looking at where the key reversals come into play and how strong the move is all the way back up here. There is another major neckline, and it's in these kinds of rallies, you could come right back up here to where this breaking candle was right there. That puts you right up here at the 200-day simple moving average. Let it be known, though, that the 50-day is slightly crossed downward and the 20 is crossing downward. That means that these trends that go up, they're going to fail. Once they put in their highs at those, whichever resistance levels they come to, you will have a reversal.